Ether versus Bitcoin, which is better for price appreciation? On average, about 600,000 Ethers are issued annually, and there's no cap on Ether supply. In other words, Ether supply is unlimited. However, the Ethereum network uses a mechanism called burning to reduce its supply. Burning is where the Ethereum network automatically removes a certain number of Ethers from circulation permanently. The more activities that happen on the Ethereum network, the more Ethers are burned. And if the amount of Ethers that are burned exceeds the amount of Ethers that are issued, Ether supply will be less than its demand. This will increase its price. On the other hand, if activities on the Ethereum network through those apps drop, the amount of Ethers burned will also slow down. In this case, since the supply of Ether is a constant 600,000 per year, less Ethers burned will result in a decrease in its price. So Ether's scarcity isn't fixed. It depends on how much the Ethereum network is used. And that makes Ether's long-term price path harder to predict. Now let's look at Bitcoin. Bitcoin has a fixed supply. Only 21 million Bitcoins will ever exist. That number is locked in by Bitcoin's programming code. It cannot be changed. Currently, about 164,000 Bitcoins are issued every year to Bitcoin miners who help to secure the Bitcoin network and keep it running. And every 4 years, the number of new Bitcoins issued to Bitcoin miners is automatically cut in half in a process known as halving. So between 2020 and 2032, the amount of new Bitcoins issued every year will be about 82,000, which is half the current amount. And between 2032 and 2036, the amount of new Bitcoins issued every year will be about 41,000. This will go on until the year 2140, when the 21 millionth and last Bitcoin will be issued. And so, can you see the difference in terms of supply that is purposely limited by design, as in the case of Bitcoin, and an unlimited supply that depends on network activities to reduce that supply, as in the case of Ether? As you have probably guessed by now, my preferred sort of value is Bitcoin. Since its supply is limited, all that is needed for it to appreciate in price is more demand for it. You can already see financial institutions, hedge funds, pension funds, even entire countries starting to buy Bitcoin in huge amounts alongside their physical gold, commodities, real estate, businesses, and other assets. They are educating their clients and citizens about Bitcoin. So more demand for it is literally a certainty moving forward. All right, that's Bitcoin for the long term. But what if you want a more balanced crypto portfolio where you can potentially make between 9 to 30% or higher a month on your capital, starting literally immediately while you wait for Bitcoin to give you your returns? By immediately, I mean within hours and oftentimes minutes from the time you get going. There is a way I'm currently using that does exactly this, and it's completely passive. No manual trading, no technical analysis, no calculations, no indicators, no staring at price charts all day. Everything is fully automated. It's so easy, any crypto dummy can do this. Want to know what this method is that almost no crypto investor knows about? Let me know and I'll reveal how it works.